Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Equinor stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Equinor is a Norwegian energy company with headquarters in Stavanger, Norway. It develops oil, gas, wind, and solar energy in more than 30 countries. It's the world's 11th largest oil and gas company in terms of revenue. Its products are essential for everyday use. The company produces petrochemicals and gas that are needed for the manufacturing of plastics, synthetic fabrics, asphalt, cosmetics, and medicine. Every single day, the company delivers oil, gas, and wind power to energize the lives of more than 170 million people, enabling them to cook, work, and travel. It is a large crude oil seller and the second largest supplier of natural gas to the European market. They also supply electricity in the United Kingdom. Low carbon is the future for our society. This company plans to be the most carbon efficient oil and gas producer. Let's get started with the model. This is a large cap company, 58 billion market cap. They're trading at $18 a share and they have 3.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. The company's free cash flows peaked in 2018 at over $8 billion. But it dropped to $3.5 billion in 2019, then $1.9 billion in 2020. 2020 was a rough year with low oil prices as well as the COVID pandemic. Net income is the profit and loss on the income statement. It's revenue minus expenses. That also peaked in 2018 at $7.5 billion, but it's negative in 2020. Revenue is the sales for the company, and that was highest in 2018 at $79 billion. But it dropped a lot the next 2 years. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. In this category is cost of labor and cost of materials. Then the difference between those two numbers is their gross profit, and that was the lowest in 2020 at $9.5 billion. Then below that is operating expenses. A couple examples of operating expenses are depreciation and insurance. Then below that is operating income, and they did have negative operating income in 2020. Below that is the interest they pay in their debt. Then below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Below that is pre-tax income, then their taxes. So the company did have negative net income in 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Free cash flow is the cash that's remaining to pay a dividend. Their entire dividend payment for 2020 was pretty close to $1.9 billion. But the company also needs money to grow their business and pay down debt. Since they didn't have much cash left over after the dividend payment, they had to issue $9.7 billion of debt in 2020. They did pay down $3.3 billion, so they added about $6.4 billion of debt in 2020. But in prior years, they were paying down more debt than they were issuing. They also repurchased $400 million of capital stock in 2019 and $1 billion in 2020. When a company repurchases stock, this decreases the shares outstanding, making your shares more valuable. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. And this company generates $10 to $20 billion of operating cash flow each year. Net income is the accounting profit and loss. You could think of operating cash flow as net income converted to cash. And the way you calculate operating cash flow, you start with net income, that was negative $4 billion. Then you have to adjust that number for the non-cash items on the income statement. They had $15 billion depreciation. They had a $2.5 billion asset impairment. An asset impairment is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. So even though the company reported a $4 billion loss, they actually generated over $10 billion of operating cash flow. Let's look at their capital structure. $34 billion of equity, $38 billion of debt. They're 47% equity, 53% debt. And their net debt is $19 billion. So if they wanted to, they could pay down half their debt with the cash on their balance sheet. And their WACC is 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $62 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $55 billion. We divide that by 3.3 billion shares. And we get a calculated stock price of $17. They're trading at $18, so they're trading at a 6% premium. It's a sell according to the model. Simply Wall Street values the company at $14, so they're saying it's more overvalued than me. It looks like the stock peaked about $26 a couple years ago. If you purchased this stock 5 years ago, the stock price would be the same as where it was then. But the company does pay a dividend, so you do receive that. Their dividend yield is 3.14%, and they pay out 95% of their free cash flow. So they don't have much money left over, which is why they took out so much debt. Their beta is 0.8, so the stock moves less than the market. The stock has gone up 5% in the past 52 weeks, which is worse than the S&P 500, which went up 17%. The 52-week low was 840, and the 52-week high was 20. The stock is trading above its 200-day moving average, but below its 50-day moving average. About 4 to 5 million shares are traded each day on this stock, and of the 3.3 billion shares outstanding, a little over 1 billion are on float. 7% are held by institutions, and it has a really low short percentage, 29 basis points. If you invested $10,000 into this company 10 years ago, you would have been up 50% after a few years, then you would have been in the red, then back up over 50%, and then back in the red. This stock is a roller coaster. The Norwegian government owns 67% of their stock. Then another company owns 3.75%. The Norway Pension Fund owns 3.5%. Then FMR, then BlackRock. Let's look at their financial ratios. The average PE in the market's 9. The median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, investors look at the price to sales ratio. Price to sales is stock price over sales per share. They're at 1.3. So investors are paying $1.30 for $1 revenue. That's a really good ratio. Price to book is stock price over book value per share. They're at 1.7. Also another really good ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet. They have $34 billion of equity, $26 billion of tangible equity, since they have $8 billion of intangibles on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity. Negative net income, negative ROE. Current ratio is current assets over current liabilities. They can easily cover their current liabilities with their current assets. Their current assets are $18 billion of cash, $8 billion of receivables, and $3 billion of inventory. So the company does seem to be well capitalized. They did have positive free cash flow, plus they have over $12 billion of working capital, and they have a $1.8 billion dividend payment. So they have over $12 billion of funding. The best way to look at ratios to compare them to similar companies, I've done videos on BP, Synovus, Husky, Imperial, Suncor, and Exxon, all in the same industry as Equinor. And if Equinor has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They are a little better in PE at negative 11, average is negative 13. They do have a really good price to sales and price to book ratio, but this industry has a really low average. They have the highest current ratio of all the companies. They have a bad ROE. They're high in debt, and they are a little bigger than the average company in terms of market cap. They pay a smaller dividend than most companies on this list. To summarize, I have them trading at a 6% premium, but this is a really big company, and it was a rough year, 2020. I'm pretty confident 2021 will be better than 2020. In the short term, this stock may be a little bumpy, but I think in the long term, it should be fine. I rank their free cash flows 3 out of 10 because they've been dropping a lot since 2018. I rank their revenue 4 out of 10. It's also been dropping since 2018. And I rank their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.